Hey everybody, Marty Missouri here, 14th of November 2023, Tuesday after the market closed. This is your midweek market snapshot. Clients, you'll get this attached to an email Wednesday morning. This will be Wednesday's morning message. And wow, what a rally today. Just one of those rip your face off rallies, as they say. As I said on Saturday, a weak CPI print would likely be notably bullish for stocks. Well, it came in weak, much weaker than most people anticipated. It makes sense to us that inflation would be coming down because we see the economy coming down over the next few months. So as I said in this morning's written note, and I think I'll just pull that over and just work from that. I wrote this right just after the open this morning. This morning's CPI print comports perfectly with our current and go-forward theses. Current being the market reaction up to a weaker than expected print, CPI print. The go-forward being that weaker inflation is consistent with a weakening economy. So indeed, we should see inflation coming down right now and over the next few months. I think it'll be choppy though. There could be some upside surprises, of course. In addition to the market reaction, which is essentially what I've been talking about now for weeks and weeks, bad news, weak news, very bullish news for stocks. Also was that I want to say on balance, not quite as bullish as a couple weeks ago, but on balance, the short-term technical setup for equities was bullish. Remember on Saturday, I said the hourly charts were looking a little bit suspect, but the daily charts were not bearish. In fact, for the NASDAQ 100, which had the biggest move today outside of small caps, it was actually bullish. To me, maybe more importantly, is how stocks are trading relative to yields and to the dollar. And they were decisively bearish in terms of the technical outlook. And falling yields and a falling dollar right now, given where we sit in the cycle or how traders and investors view things, those are bullish dynamics for stocks. And both of those did exactly what you would expect, both based on the technicals and based on CPI, and I'll show you those charts here in a second. Now, folks, the problem that we keep expressing, most recently in last Friday's video, is that investors forever at this stage of the cycle get sucked in by deteriorating data as they anticipate a friendly Federal Reserve response, only to suffer the disappointment, if not devastation. Remember those graphs I showed you of our PWA index turning red, big market ramp before the last two big bear markets, monster declines in stocks. And those come with a recession-induced last leg down of a bear market. So this is key right here, folks, is there going to be a recession? If there is, stocks are not pricing that reality by a long shot. So that's why clients, we continue to hedge with put options. We continue to stay very diversified. We had a great day today. We had one down position of our 32, and that was ag futures. It was down 49 basis points. Of course, yesterday, when stocks were down, certainly the S&P and the NASDAQ, that position was up 149 basis points. So it was up 1.5%. So that's the key when you manage a global macro portfolio, is it's not a stock market portfolio. Sometimes it's got more stocks, sometimes it has less. We think negatively correlated assets or uncorrelated assets in a good portfolio make a lot of sense. And given our macroeconomic outlook, got to play some defense right here. But it doesn't mean you can't make money on up days. It just will come from different places. So again, today was a very good day for our core, but it wasn't all about the stock market necessarily. Just looking across the positions, REITs were up 5.4%, and that's just a position we just recently added. And by the way, it's not office REITs, by the way. Metals miners was up over 5%. We still have that little position in Dutch Bros, which was up 4 point something percent. Mexican equities were up 4%. Rare earth miners were up 4%. Water infrastructure stocks were up 4%. Silver was up 3.6%. Brazil equities were up 3.25. European equities were up 3.1. Now we get to something in the U.S. U.S. material stocks up 2.95. But then emerging market stocks up 2.7. Asia Pacific up 2.4. Another emerging markets position up 2.3. long-term bonds up 2 percentage points. And then U.S. industrials up 2%, U.S. tech up 2%, Vietnamese equities up 2%, and so on. So anyway, you get the point. So clients, of course, you know this, but just thought I'd express what went on today. And so again, we are not tethered to the S&P 500 except with the defensive put options that will go up in a real big way if the market comes down in a real big way. Not to ramble too much here. Now, I can't stress this enough, folks. I am not speaking inevitability when I talk about being defensive. I'm simply speaking the risk-reward setup as we go forward. Today's news about CPI, rather than taking us out of the woods, as you might think by the market reaction, confirms to us that we are deeply within. However, if we indeed happen to escape the woods without recession and inflation settles back to its 2% target, all's good in the land of equities. And then we introduce and add to positions in asset classes that our long-term thesis says will shine over the years to come. Frankly, we have very high conviction on certain asset classes and parts of the world and currencies and so forth, but we don't want to go there in a big way at all when our recession light is still lit. And here's what I'm saying. Odds that we'll be able to capture them at more attractive, i.e. cheaper levels over the coming months are simply too high to ignore. Just to kind of put today's rally into context, if you looked at Citigroup's fear-greed barometer this last week, it said net fear. So this is what you would expect if there's on balance more fear than greed in the mind of investors. That means they're maybe sitting with liquidity, they're out of stocks, what have you, or perhaps you could say they're underinvested. Then you get something that sparks a rally and they start thinking differently, and then they all rush in and it exacerbates the upside. So some of that, I will say though, our own fear greed index just moved over to net greed, and it's probably going to move over there a lot bigger if this week continues the way it started. Now, other things though, other internal things come into play that really have nothing to do with bullishness. They have to do with protection. So we've talked in the past a lot about the massive volume of options trading that's going on in today's market. So if you're an options dealer and you had folks who had bought puts expecting a hot CPI print or expecting market to start reacting to weaker economic news like we think is a next year story probably, but you think it's now, so you're short the market with put options. Well, the dealers who sell those put options, they take the hit if indeed the buyer is correct and the market goes down. So they short the underlying stock or the underlying security so that if it does go down, they have gains themselves that offset the losses that they incur in the put position that they're short, the one that they sold to the investor per se. So when the market goes up and those puts are rapidly closed, well then those dealers cover those shorts. They buy those stocks because you got a short of stock is one that ultimately has to be purchased. So that buying of those stocks pushes on the market to the upside. Then if those put buyers or any buyers, for example, suddenly load up calls because now they are massively bullish for the last 6 weeks of the year. So the dealers who sell them those calls, if those underlying securities go higher, well, those dealers are on the hook. So they actually buy a certain amount of the underlying security. So they're just acting on their own best interest to hedge their own positions. And so they end up buying those underlying positions, and that just exacerbates it even higher. And then, of course, just shorts in general. Panic, of course, because markets can go up to infinity. And if you're short, that means your losses can go up to infinity. So therefore, these people buy to cover. So massive short covering, massive action in the options dealers. People really excited about what could happen at the end of the year. Professional managers who feel like they need to catch up, it's career risk, what have you. That whole fear-greed response among individuals and among professionals is going to do a real number on the extent to which a market like today's rallies. And I think this sentiment is ingrained short-term, and that is good news is bad news for stocks, bad news is good news. Today was weak news, not necessarily bad news. It's good news that inflation is lower, but bad economic news would suggest recession coming or weakness coming, Fed then coming to the rescue. Strong economic news is the opposite. So if we get a real barn burning retail sales number tomorrow, right, better than expected, well, then I think stocks would probably trade off. Because that would suggest that, if people are still out there buying, then inflation is going to probably stay very stubborn, if not go up. And that, therefore, if weak retail sales come out tomorrow, look for a rally. I don't know if there's enough oomph to get anything like today, but we could see the market close in the green tomorrow, even after this just an insane day today, right? Ultimately, though, we're talking about over the next few months getting to a point where absolutely retail sales will be weaker, and absolutely that'll be very negative for the stock market, because it'll also portend weaker earnings and stocks having to be priced relative to earnings. So I pulled up this chart as well. For whatever reason, the S&P 500 earnings only goes back here to the 90s for this database here. But this is I like to call it my Wile E. Coyote chart, right? So this is part of our PWA index. It is the leading economic indicator to coincident economic indicator ratio. So when this is going down, leading economic indicators are doing worse than the right now, so to speak, coincident indicators, suggesting that things are weakening going forward. You can see how that looks. All these red shaded areas are recessions, right? So you can see how that looks heading into recession over and over and over again. And if you look at the level right here, we've never been here without either being in recession, about to go in recession, coming right out of recession, but there's a recession in there in every instance. The orange line, S&P 500 earnings, notice how this rolls over and then earnings tend to follow. Stubbornly, earnings are still going up, right? And then kaboom, they follow. And, again, it's the Wile E. is running off the cliff, looks down, and then, there you go. So this, we believe, is what would happen in a recession scenario, and stocks are still trading up here with earnings expectations like this, which could be sorely disappointing, once again, in that recession scenario. One more, but promised in the written note we'd look at this. So S&P 500 price to earnings ratio, and this takes me back to 1991. And what I did is I circled where it bottomed in the bear markets that have happened since then, right? So company share price relative to its per share earnings. How low does it get, or how low did it get during these previous bear markets? We almost had a bear market right there, European debt crisis period. But coming off of here last October, and I think we could go back 100 years, and I wonder if we'd ever find any period where a new bull market began from a 17 PE. Typically they go lower, and right now we're back up to a 21, which rivals the late 90s. These weird blips, folks, what this is tons of stimulus coming in, corporate earnings not going up or even going down, but prices going up because people are buying it because the Fed's throwing $5 trillion, at everybody. And this is a precariously high level historically. The 2008 bear market, I remember talking back then, telling folks, stocks aren't overvalued right here. So this is not a stock market bubble. We did see a 60% decline in stocks because of how bad the economy got. This up here in the late 90s was your classic stock market bubble. Prior to that, you got to go back to like 1929 to see anything that extreme. We got there with that weirdness around COVID, but again, we are in that danger zone in terms of price to earnings. Now, folks, earnings can be manipulated. Sales, a little harder to do that. So price to revenue, a whole other proposition. So here are the levels price to sales got to during these previous bear markets, and here's where it came off of here. So again, the odds of a durable, long-term, brand new bull market, just from a valuation standpoint, if not from dozens of other standpoints that we talk about here, you can't really have, or I can't really have, a high confidence level from these valuation metrics. The other one we have in our model is price to book value. And same thing, right? Just a really high level relative to where you typically see it coming out of bear markets. A couple others that we have in our equity market conditions index, I just pull off the internet. One is the Buffett indicator. It's like 1 point something standard deviations above the long-term norm. That's the overall stock market capitalization versus GDP. The other one is the Shiller's CAPE PE, cyclically adjusted price to earnings ratio. It is historically high, second highest only to the late 90s. So again, from a valuation standpoint, this just doesn't look like the place where you would back up the truck and buy stocks. Okay, so that's it for the narrative. Folks who don't want the technicals, thanks again. For the rest of us, let's just do this quickly. The S&P 500 daily chart, we exploded and broke out above that downtrend line. And what do we create here? A nice big fat gap that obviously I'm leaning toward it ultimately filling. Doesn't have to be right now, doesn't even have to be this year. Very well could be. You can see we got stopped right here where we got stopped in September. Again, though, acceleration to the upside. Like I said, when I just look at this little area right in here, this is not bearish, right? Now, when I go back to the peak, to the July peak, and this is not the all-time peak, that was back in January of 2022. So this is setting up now on the daily chart like something that looks, somewhat precarious. We're going to come into next year with probably a fairly bearish look, at least on the daily chart. On the 60-day, 60-minute chart, remember I drew this rectangle in here. I said it looked like this, only it looked like we were going to break lower, and that obviously didn't happen, right? We broke out hugely, today. Again, these are hour bars, but we still have our bearish divergence. So actually, this didn't get any more bullish, but the daily, as I said on Saturday, looks bullish enough. And like I said, we could see this thing continue to scream higher, particularly on the NASDAQ 100, where I said the daily did look bullish to me on Saturday. Screamed out above this level here and just almost above my big yellow line here, which would be that July high, but definitely have the makings of longer term several month bearish divergences, and those tend to not end super well, but if we just keep melting higher, we could even burn through that. On the hourly, remember we had a rising wedge pattern, bearish divergences. Well, we broke out alongside that and then just exploded higher, right, again. But it doesn't look a lot better to me right here in terms of the very short-term outlook on the hourly. Daily still looks compelling enough, but as I said, we're now getting to some pretty extended divergences even on the daily. So we shall see. I still think it's definitely within the realm of possibilities that we close higher as we get toward the end of this year, but there's a lot to play out even in the short run over the next 6 weeks or so. Things that were real compelling to me, though, more so even than the equity charts, were the 10-year yield. And again, right up in here, we're talking about the probability that it breaks lower, the kind of classic pattern that we've worked for years. And sure enough, that's how this played out so far. Massive down candle today, right here. Yeah, it looks very much like a bear flag pattern. So we need a lot more weak economic data to see that kind of fall in 10-year yields. But this all made sense relative to what the technicals said, and certainly relative to how yields would react to a weak CPI print. As for the dollar, again, I told you a lot of people disagreed with me on this one when we were right up in here, because I said this is a bearish looking chart. I even drew, kind of a potential bear flag there. I said it wouldn't surprise me if that's how it plays out. Literally, it pretty much played out today. So if we get a strong retail sales number tomorrow, dollar is going to pop higher, probably. Yields will probably pop higher, and probably stocks would pop lower if it's a strong enough retail sales. If it's weak, you're just kind of going to get more of the same. This is still a near-term bearish chart for the dollar. We have a recession. If it's a hard landing, especially, people will rush to treasuries from all over the world. Dollar will ramp up during recession. Once we get through all that, folks, we are long-term. For the next decade or so, we think the trend in the dollar is going to be lower, and we're looking forward to that period because a trending lower dollar offers up massive macro investment opportunities. So we'll see how that plays out. But right now, we don't want to put that cart before the horse. We don't want to get cute right here. We just want to be uber patient as the rest of this cycle plays itself out. I'll leave it there. Folks, thank you as always for watching and listening. Take care. Bye-bye.